Jerry, welcome. And yeah, I'm close to a bottom. I don't think there's any sense in us trying to pinpoint, bottom here or bottom there, bottom everywhere. But what do you think in terms of the Fed and recession risks? Why do you sound relatively sanguine?
Well, I mean, the first thing is I kind of sound crazy with Apple trying to make a new low.
Sure.
And guessing that the overall market, its biggest stock is breaking down. But looking back over all those questions you raised, I mean, when you think about it, all this exercise we've gone through and we're continuing to is this idea that the Fed controls financial markets, earnings estimates, and global growth. And I'm afraid they've had an influence here on financial markets this year by pulling all the liquidity away. But they certainly don't control global growth, I think, to the extent that investors think or believe. And what we see happening is this whole fear, though, an entire purpose for the increase in rates has come based on the view that inflation is going to sustain and be with us for a long time. And you don't see evidence of that. It's already rolled over on the CPI.
Jerry, here's my question. So and this is what Steve was reporting last hour. Inflation is peaking, and it's peaking globally, he says. But you and I look at the market today, and we see Apple hitting new lows, and the 10-year up at 385. I mean, it makes you a little uncomfortable.
Well, first of all, you should always invest with a little fear, right? You usually get in trouble when you're very confident of something. No, we have to have some opportunity to make a mistake, and this is why we think if you set aside the things like Apple that are in the position they're in, where investors are very overweight and very worried about their markets and their margins, that's fine. But you forget about why is the market now significantly higher for housing, industrials, financials, a lot of the names that you would have otherwise expected to be working to new lows right now.
True. And
they're significantly higher than this summer and fall's lows. So there is something else going on right now, and it's not something the Fed will ultimately correct. It's really there in the valuations of these stocks.
Jerry, hey, it's Brian. Listen, let's try to be optimistic going into the new year, shall we? Terrible year for stocks and bonds. And to follow up on what Bob Pisani said, I want to ask you if you've got a view for next year, and here's why. It is very rare that the S&P 500 or the Dow go down 2 years in a row. We know that, so that looks good. However, when they do go down 2 years in a row, I read over the weekend, the second year tends to be worse than the first. So if we're down next year, it might be an even bigger drop. What is your take on 23?
My take is each of those examples that you cite came in a financial crisis, the recession, or the depression, the great financial crisis. We don't have that type of structural underpinning. The European banks, the U.S. banks, all the banks in the financial institutions of the world are vastly more stable and have better balance sheets going into what, again, is this feared downturn. And I would also point out, we haven't talked about this, but the fact that China now is going to pull forward a reopening cycle that took us 2 years, they may be done with their entire reopening here in the next 3 or 4 months. And that's the biggest economy in the world set to grow again for the first time. So that's not part of these other narratives that I think has been grossly underestimated.